biggest money made for sellers is many times in the second sale, even more than the first sale. What is the second sale? How does equity rollover even work? Well, these are the 5 things you need to be aware of if equity rollover is a component or being discussed, or you want it to be discussed in your sale of a business. I'm Arthur Petropoulos, Managing Partner and President here at Hillview Partners. We're a middle market investment banking firm helping companies across geographies and industries generating $1 million to $20 million a year in pre-tax earnings or EBITDA to sell their companies or secure capital. So what is equity rollover? And so in other videos that we've made, we'll throw a thumbnail somewhere on the screen, we've discussed the 3 primary components of post-transaction consideration. What does that mean? You get cash at closing, and then oftentimes there's stuff you get after closing. That usually takes the form of an earnout, form of a seller note, or form of equity rollover. We've been seeing more and more over the last 2 years equity rollover, rolling forward some ownership in the business being a component of deals. And in many times, it's not as well understood as an earnout, saying you have to hit these targets and things happen, or a seller note. We're going to pay you X dollars over time with this interest rate. People say, what is rollover? I don't get it. I thought I'm selling the company. What does this even mean? What do I actually own? And so let's break it down in a simple example and then dig through 5 of the key or the salient or most pertinent variables about equity rollover that could make it a great idea or a terrible idea in your sale of the business. So equity rollover. Think of it this way. Oftentimes, a buyer is going to buy your company and 5 other companies. They're going to then take that aggregation of businesses and sell them, again, call it 5 years down the road, 3 years down the road, as an aggregated bundle. We've talked in older videos about how private equity works, and oftentimes the aggregation or the consolidation of businesses and profits can create a higher multiple. So, for example, if a company buys 10 $1 million companies, this is the example we always use, for 6 times earnings, so they spend $6 million buying 10 different companies that are generating $1 million of pre-tax earnings, they will spend $60 million, right? 6 times 10, right? So 10 times 1 equals 10, 6 times 10 equals 60. They'll spend $60 million buying $10 million worth of profit. However, once they have that $10 million of profit put together, they can sell the totality of the $10 million for maybe 10 to 12 times that. So that is the idea of private equity. They can buy things, put them together, aggregate, roll up, consolidate, all phrases that you'll hear, and then they can sell it at an expanded multiple. So they could buy things at $60 million and sell the aggregation of it for $120 million. We go into detail in other videos about why that makes sense, how the capital food chain works, but take that as a baseline assumption that people are trying to buy that. So now, oftentimes when private equity is buying companies, they are saying, well, how do we keep people involved for some period of time? And it's not always that whole 3 to 5 years, but how do we keep people invested in the situation? How do we give people some more upside in it? And so, and sellers are getting smarter too, saying, hey, look, we'd want to continue to reinvest some portion of the company going forward. I shouldn't say smarter, it's just preference. Sometimes people want all the cash at closing. Sometimes it's going to be more capital they're going to invest anyways, and they may as well keep it rolling forward. So what you'll see sometimes is, let's say a company is going to buy, for round numbers sake, and we're going to always push for higher valuations in our situations, but let's say they go and they buy $1 million of EBITDA for 5 times, so for $5 million, and they allow and they ask, and it makes sense for the seller to roll forward $1 million. They may go around and buy 10 of these companies, so again, they'd spend $50 million presumably, but they'd say, okay, we're going to give $4 million in cash to each of these sellers, but we're going to give $1 million in rollover. That means instead of getting $1 million in cash, you're going to put forth 20% of your ownership into this new aggregation of business. And so the idea being that you will now retain basically 20% of the value of what you contributed. So if they're buying $50 million worth of companies, so 10 times $5 million, right? So if they buy $10 million of EBITDA at 5 times each, and you roll over 1 million of the 5 million that someone was going to give you into equity, you would presumably own 2%, so $1 million of the $50 million that have been aggregated. Now, assuming, again, using the example that this $10 million of EBITDA can be sold for 10, let's say 12 times in this scenario, so for $120 million, you would own 2% of that $120 million, which equals $2.4 million. So the idea is you sell the first part of the company for $4 million, you sell the company for $5 million, but you take 4 in cash, you roll 1 forward, and then you own 2% of the larger aggregation, and when that sells, you make 2.4 million. So in total, you'd earn $6.4 million. So that's the math equation. But I would say is we've never seen a situation when done right where the equity rollover is worth less than really 2 times what you put forward. So the rollover. So usually over a 5-year period is the average. And then the private equity firm may sell the company again. And that's where that second bite at the apple or the second sale happens. And so that's the idea of the second sale. Now to quickly walk through kind of what are the 5 things you need to understand to make this second sale make sense. Well, right, you are going to own some piece of the aggregation. So what it's worth is really going to be what you own. And so, not to sound prophetic, but question number 1 is the quality of the partner. Look at the track record of the acquirer. We have a private equity firm that we work with that on almost every situation, the equity rollover has been worth 6 times as much when it's ultimately exited, and they have a long track record of doing so. So we feel highly confident that when they pick out a thesis, they're going to add value and really grow things in order to do that. So in those situations, say we sell a company for $6 million, we've had situations where $5 million of it turns into cash day one, and then $1 million of it turns into $6 million down the road. And so ultimately a $6 million sale on paper turns into $11 million of proceeds, right? But look at the track record. If they've duffed rollovers where they haven't worked before, if they haven't done any, those are a lot trickier. You got to really know who your partner is going to be because you're going to own something on a continued basis. Variable number 2 is composition. What is it that you actually own? And so the simplest way to protect your interest is the self-interest of others. And what I mean by that is if you're going to get rollover, if you're going to have equity in the new thing, we always say, look, whatever the private equity firm owns, we want to own the same thing. Because they're not in the business of losing money. They're going to be zealously advocating for it. And so we don't want some B shares. We don't want some preferred junk. We just want the same stuff. We want to eat the same cooking that you're going to eat. So we are aligned. Because you can rest assured, if it's you show me an incentive and I will show you an outcome. If your interests are aligned with the sponsor of the deal, with the private equity firm, it will work. So say, okay, who is my partner? And I want to own the same thing you're going to own. We're going to be in the same seat. Number 3, governance and visibility. So what we mean by visibility is, let's say you sell your company and you're only going to be involved for a year, but presumably this next chunk, if you will, this next iteration of ownership is going to take 3 years before it's sold again. You need to be able to see into it after that. And so you say, look, I want quarterly financial reports. I want to be able to call someone and see how things are performing. I want to vote, if you will, if you're going to stay involved, to have a say in things that's pro rata with your ownership, kind of like a shareholder vote. And so that's important. You don't want a black box where people say, hey, you know what, we'll let you know how this thing goes. It's not a lottery ticket. It's an ownership in an enterprise, and the visibility and rights, if you will, must reflect that. Number 4 is future dilution. And so what we mean by this is if you were to be the first sale, if someone buys you for $6 million and you roll forward $1 million, you're going to have 16.67% of the new entity. Now, if they do the same thing again and buy a different company, you're going to have 8 1/3 of that if they replicate the same thing. Now, you're going to have a slice of the pie that changes shape, but as the pie gets bigger, the actual aggregate shape, the aggregate size of your slice is going to get bigger. So what I mean by that is if you own 16.67% and they buy a company that's doing exactly the same thing for the same price, you're going to have 8 1/3% of the new entity. You're going to own basically the same amount of economic value because now the company's twice as big. However, because the company's twice as big, it's going to trade for a higher multiple, and therefore you're actually increasing your value. Now, what you need protection against is you can't have them going out there and making dumb bets all day or overpaying for things. And so understanding what the rights are in terms of can they dilute you further, to what extent, do you have any say, and do you have any kind of a liquidation mechanism if you disagree with some of the future acquisitions? These are all important things. And so we'll get into that last one as the number 5 here. And that's really going to be time horizon and structure. And so usually in a rollover piece of a deal, the buyer says, look, I don't know exactly. It's a kind of an estimate as to when they perceive the next sale of the business. Sometimes a gigantic company comes around and wants to pay a huge amount of money, and so they'll sell it in 2 years. Other times, the market for, just call it the macroeconomic environment, can dip in year 4, and they say, you know what, let's hold this until year 5. And so there are outside factors that can drive the optimization of timing one way or the other. And so what we try to do in these situations is let's build in an ejector seat. Like, let's build in some structural component that allows us to get out of the deal if we don't like it. And so I shouldn't say don't like it, but if we feel like the timing of things is not aligning. So what we've done in historical deals is said, look, we want a compound interest rate on our equity rollover of 10%, of 8%, of 9%. It's different situations depending on the scenario. And therefore, after 3 years, we want the right to ultimately get out of our position, monetize, liquidate our position, even if the company has not sold, because we want that right. So that way, if we feel like it's just getting long in the tooth, if the sellers, life scenarios change that they want to capitalize it, that there's already a mechanism. Again, asking for something after the fact always gets a worse outcome than kind of pre-planning it. And so we say, look, we want a 10% compounding interest rate on it. So compounding important because you say, okay, 3 years, we're going to go from $1 million to $1,100,000 to 1.21 million to then 1.34 million. But the point is, it keeps getting slightly bigger every year, kind of a ode to the Buffett snowball. So the idea is that after 3 years, if you're not confident, you can at least get out of it at, call it $1.4 million on your $1 million, right? If you wait 5 years, maybe it's $1.7 million. And so therefore, you kind of build in a floor of what your returns will be. So if you feel confident with who your counterparty is, it still helps to have this mechanism. The interesting thing is that I don't think we've ever, I'm trying to think of it, in the many, many times we've done these situations, I don't think that the sellers have ever, maybe in one situation where they partially did it, actually used this ejection seat. Because if you vet the buyer and you're confident in their abilities, then they perform. And if you feel like, okay, there's usually like an internal stock price that they keep for the value of these things. So if the value of the stock is already, call it 2x, and it's moving in the right direction, then you're not really going to be inclined to monetize it. But you still want the right to, you still want the ability to. You say, look, I want all options on the table, and some we may take and some we may not take, but it's still a valuable thing to have. So the idea of equity rollover is, in a simplistic fashion, a lot of times now, particularly these last few years, you sell 80% of the company, 70% of the company, 90% of the company, and you push forward 30%, 20%, 10% of the business to still own it in the next iteration of the company as they keep aggregating businesses in order to sell it, call it 3 to 5 years down the track at a much higher multiple, creating a second exit. And that is kind of the second exit, second bite at the apple. You'll hear these phrases being used, and oftentimes it can be, again, if you sell the whole company for 5 to 8 times and you roll forward 10 to 30%, there's a lot of scenarios where, if performed correctly, that second bite of the apple can be just as big as the first, and it can really be a win for everybody, which is exciting and which is precisely what we're aiming for. However, to recap what we've discussed in this video, the 5 things you really, really, really need to be aware of and to keep in mind and to vet out with your banker as you're contemplating and negotiating the deal are: 1, the quality of your partner. That matters. You're rolling forward equity and you're buying equity, let's say, in the new thing effectively by rolling your money forward, but you're really buying a partnership. You're really creating a new chapter working with someone else, and you have to be comfortable, confident, and understand their track record and capabilities in doing that. Secondly, the complexion. Eat the same cooking. Just keep that mantra in mind. You want the same stuff that they have. You don't want wampum. You don't want some make-believe nonsense. Same stuff. Nice and simple. Number 3, you need visibility into what is going on. You need voting rights if you want to be involved, but you have to know what I cannot measure, I cannot improve. What I cannot see, I cannot opine on, and therefore you need visibility. Number 4, dilution. How much can you be diluted? What protections do you have against it? And number 5, kind of funneling in from that, what is the contemplated time horizon, at least from an estimated perspective, and is there a mechanism, and should you build in a mechanism, oftentimes we say yes, that will allow you to monetize it at a compounding interest rate, agnostic of kind of the ongoing performance of the business. These are the 5 things. If you have these things hashed out, then your second exit will be a lot prettier. And more importantly, will have a lot less risk. So that's a thought for this week. Rollover equity. What is it? How does it work? Is it worth contemplating? And if so, how do you optimize it? Hope the week continues to go well. Keep pushing forward. God bless. We'll see everyone next week.